Welcome to The Explainer. Look, today we're decoding the current state of the stock market and uncovering exactly why buying in really uncomfortable times might actually be your best move. We are living through one of the strangest times in modern investing history right now. It's a time filled with unbelievable hidden opportunities, but only if you know exactly where to look.
So, are we secretly in a stock market crash? Let's dive right into this massive question. Because while the major indexes look absolutely great on the surface, the underlying data is telling us a completely different story. If you glance at the S&P 500 or the NASDAQ right now, you'd think we're in this incredible, high-flying bull market. But if you've been scratching your head wondering why your specific portfolio isn't reflecting those record highs, you are definitely not alone.
Section 1. The Masked Bear Market. Let's completely shatter the illusion of the current market and uncover what is really happening beneath the surface.
The current market is literally like looking at a sleek Ferrari. You see this shiny exterior, the major indices bumping up against all-time highs, and you think, wow, I can't wait to drive this. But when you pop the hood to look at the individual stocks that are supposed to be powering the market, there is absolutely no engine driving it. It is completely hollow.
Think about a normal bull market for a second. Usually, you'd see 70 to 80% of stocks sitting comfortably near their highs. But today, it's a totally different reality. If we look at the distribution of the Russell 3000, only about 35% of stocks are within 10% of their all-time highs. Meanwhile, a massive 40% are in pure disaster mode, down 30% or more. A staggering portion of the overall market is just deeply in the red. So the really crucial takeaway is this staggering reality. 65% of stocks are currently down double digits. We are actively navigating a masked bear market. It's a bear market in disguise, entirely camouflaged by a handful of mega-cap tech giants pulling the averages up. Most individual stocks are frankly getting hammered right now. But, as you'll see in a moment, this exact kind of environment is what sets the stage for building generational wealth. Which brings us to Section 2, Buying when it's uncomfortable. Let's see how this hidden bear market creates some massive, albeit very uncomfortable, opportunities for investors.
You see, human psychology practically begs us to wait for perfect, sunny conditions before investing. But as we saw with early Palantir investors, life-changing gains happen when things look incredibly murky. If you wait until a company is wildly popular and everyone at the party is talking about it, you're usually buying at the top. You have to buy when it feels physically uncomfortable to click that buy button. That is where the big money is actually made.
On the flip side, chasing hyped companies might feel safe, but the math shows you're risking years of dead money. People rush into popular names strictly out of FOMO. Take SpaceX, absolutely incredible company, but it probably won't even see profits until the 2030s. That's a highly dangerous play for big money right now. Or look at memory chip stocks. They go on these huge ripper rallies, sure, but they are brutal cyclical traps. When that cycle turns, those stocks become dead weight for years.
Section 3. Meta's CAPEX Crisis. To truly understand why genuinely great companies can have struggling stock prices, let's look at a fascinating case study.
Meta's stock is up a measly 8% over the past 2 years. Now, you might be wondering how a tech giant with incredible revenue is barely moving. Because beneath the surface, Meta is showing astonishing strength. Their revenue growth recently has been among the best we've seen in years, their margins are strong, and their balance sheet is pristine. Yet the stock has essentially flatlined. The answer lies entirely in their spending.
It all comes down to a massive spending crisis. Meta is projecting to spend vastly more on capital expenditures. We're talking billions upon billions on AI infrastructure and servers than they will even make in net income this entire year. Imagine jumping from a highly manageable $28 billion in CapEx a couple of years ago to a staggering potential $145 billion this year. When your projected net income is only $80 to $90 billion, that creates a structural problem that absolutely terrifies big institutional money. Because the math just doesn't add up, Meta has a massive funding dilemma. They basically have to choose between three very unappealing options to pay this $145 billion bill. They either drain their massive cash reserves, they take out debt and ruin a historically clean balance sheet, or they dilute shareholder value by printing new shares. None of those options are good. And it's exactly why the market is aggressively hitting the pause button on Meta. And this brings us to a crucial concept, the broken stock. A broken stock is a fundamentally strong company whose share price is temporarily depressed by extreme financial burdens or terrible market sentiment. That perfectly defines Meta right now. It's a broken stock, not a broken company. If you buy a stock like this, you have to be willing to, metaphorically, put it in a filing cabinet and ignore it for a while. But because the underlying business remains so incredible, when it finally makes its next explosive move, it is going to be spectacular. Section 4. Hidden high-growth opportunities. Let's shift gears away from big tech for a second and uncover some high-growth turnaround plays that the market is currently ignoring.
Now, if you assume you have all the time in the world to buy these beaten-down stocks, waiting could literally cost you a massive window of opportunity. Investors see stocks sliding and think, hey, what's the rush? But look at Celsius. Yes, it's down 34% over the past year, but historically, this is a stock that rocketed from $30 to over $80 in a single year when sentiment shifted. You do not have forever to enter these positions before the wider market wakes up.
Just look at e.l.f. Beauty as a prime example. In just a few weeks this past June, the stock suddenly moved up nearly 30% out of nowhere. Sure, it's still down 45% over the past year, but this is a company that previously ran from $20 to $200 in just a 2-year span. When turnaround momentum strikes, it moves incredibly fast. You can so easily get left behind waiting for that perfect entry price.
The lesson here is that you simply cannot time the bottom. Turnaround momentum is shockingly fast. Look at Estée Lauder. It rallied 116% in just a 9-month span once its turnaround finally began. That signals exactly what could happen to a brand like Nike, which is down 29% over the past year and waiting on a similar consumer sentiment turnaround. When the tide turns, a stock like that could easily surge before you even realize what happened.
Section 5. Playing the long game. As we wrap up this explainer, let's focus on how to strategically position yourself over the next 5 years. If you're looking past the daily noise, these 5 tech stocks represent incredible long-term value for anyone willing to endure the current market pessimism. Number 1 is Meta, because despite those murky capex waters we talked about, the long-term upside is undeniable. Then you have Salesforce, where the market is vastly underestimating their potential again. Amazon's massive capex is perfectly balanced by their AWS infrastructure. Netflix has emerged as an absolute long-term giant. And finally, ServiceNow. It's a hated stock right now, but it is uniquely primed for the incoming wave of AI agents.
Ultimately, building wealth really comes down to a clear choice between the trap and the strategy. The trap is gambling on hyped, cyclical stocks at their peak valuations. The strategy, buying high-quality, beaten-down companies when absolutely no one else wants them. While the crowd is throwing darts at unprofitable space companies or cyclical chips, the smart money is quietly accumulating broken stocks with flawless underlying businesses.
So I'll leave you with this final thought to consider about your own investments. Is your portfolio built for the fleeting hype of today or the undeniable reality of the next 5 years? The generational wealth is going to be made by those who can actually stomach the discomfort. Thank you so much for joining me for this explainer. Stay curious, and I'll catch you next time.